the white line is what you tell Wall Street in terms of what you make on paper. The blue line is what actually appears in the bank account. So why could there be a gap between what you tell somebody you made, I made $1, versus what's in the bank, 50 cents? Well, the reason is that there's all kinds of accounting tricks that you can use, accruals, inventories, and all of these things allow you to present a healthier earnings report than is actually true.
Hey guys, welcome back to the channel. Today we have Chamath on the In Podcast discussing the current state of the market and the ever-growing concern over the inflation that's coming in 2023. While the market braces itself, the consensus view is that inflation will continue to run hotter and the upcoming prints over the next 8 weeks will be crucial. Chamath emphasizes that if allocators of capital are unsure about the direction of rates and inflation, everything can shut down, which is detrimental for the economy. He suggests that it may be profitable to go against the consensus view and predicts that the Fed funds rate increase could be a sign that the market is overvalued. Let's check out the latest interview with Chamath as he gives us his market outlook and what we can expect from the Fed heading into the first half of the year. Don't forget to like and subscribe if you enjoy the content we do here on this channel. Let's get right into the video.
My governing principle, I think I probably said it too many times, but I'll say it again. Rates are going to be higher than we like, and they'll stay here longer than we want. So if you use that as a principle, whenever the consensus thinks we're done, it's been pretty profitable to be on the other side of consensus. And so I still kind of maintain that we're probably going to have a 5.5% Fed funds rate, which means that, I don't know, maybe Credit Suisse will offer me 7.5% soon on 3-month T-bills, but we're going to have higher rates. And I do think Brad's right, though, in the sense that as long as we know that then that's it, and we can forecast it into the future without it changing too much, it'll be okay. But right now, what you're seeing is a lot of make-believe going on in the stock market. So Nick, if you want to just throw up that image. So this is a really interesting
This is the chart of cash flow versus earnings?
Yeah. So this is something that I saw on Bloomberg, which I thought was really interesting. And if you focus on the period of 2020 to 2024, what you see is the white line, which is net income adjusted for depreciation and amortization. And the blue line is cash flows from operations. So what does that mean?
And this is for S&P 500 firms.
This is the best 500 companies in the world.
Yeah.
And the white line is what you tell Wall Street in terms of what you make on paper. The blue line is what actually appears in the bank account. So why could there be a gap between what you tell somebody you made, I made $1, versus what's in the bank, 50 cents? Well, the reason is that there's all kinds of accounting tricks that you can use, accruals, inventories, and all of these things allow you to present a healthier earnings report than is actually true. And so right now, we have the worst earnings situation, so the worst gap between what we are telling people versus what is actually in the bank account that we've had for 30 years, since 1990. And so it just brings into focus the fact that we may be in the last few innings of trying to make sure this all looks okay, in which case, one faction of the investing world who thinks that this earnings recession is actually at hand would be kind of right. And then what they would say is that once we all realize that these earnings are fake and you reset down 15%, that's where you get to the mid 3,000 in the S&P 500. Right now, it's around 4,000. I don't know if that's true or not, but there's more and more evidence that would support that the way that they see the world could be credible. The other side says, hey, listen, this is a bump in the road. We're getting a handle on things and it's stabilizing. So even though it's higher than we'd like, it's not going to change that much. So now just think about 10 and 15 years from now and let's go. You have to understand, stimulus is still entering the economy. It's just harder to measure. So for example, take Social Security. You have cost of living adjustments in Social Security that's lifting payments by 10 and 15% because it's backdated for what was going on last year. And remember last year, we had 2, 3, 4, 5% inflation rates. So there is more and more money coming into people's pockets that we don't realize. And we're all on the hook for that as US taxpayers. So I think it's very dangerous to kind of look at one data point and try to pick off what's happening in consumer land, because there's all kinds of hidden ways in which money gets back to people.
Chamath notes that stimulus is still entering the economy and is harder to measure. He cites the cost of living adjustments, which are lifting payments by 10 to 15% due to inflation rates. He warns against looking at only one data point to understand what is happening with consumers and points to the hidden ways in which money gets back to people.
I think this is a good time to maybe talk about the public markets and inflation and what we're seeing in macro. So,
can I set up a question for Brad, actually?
Sure, go ahead. Yes.
Yeah.
Lovely.
So on a previous podcast, I laid out my theory of how you could just use the 2-year bond rate relative to the Fed funds rate to understand where the bond market's sort of prediction market about inflation is going. And a month ago, the 2-year bond rate was at 4.1% relative to 4.5% Fed funds rate. So in other words, the bond market was betting that interest rates would go down between now and 2 years from now relative to where the Fed had it. So therefore, it believed that inflation had been conquered. Now, fast forward just 1 month later, and the 2-year bond rate's at about 4.9%. The Fed funds rate's about 4.5%. That is a massive swing, basically 80 basis point swing in the 2-year bond rate. And so the markets seem to be saying all of a sudden, not just that they expect rates to be higher longer, but also that the Fed needs to keep raising. And that is a big change. So Brad, what is the basis for that? And what do we now believe about inflation? I think just a few weeks ago, we were thinking that this problem was licked and the market took off like a rocket. It ripped. Now, all of a sudden, it seems like investors are really worried that inflation is not over. So where does this stand right now?
Well, I think when we started the year, the 10-year was close to 3.2, where now we're closer to 4%. The 10 minus 2 is as negative as it's been in the last probably 10 years. So the market is clearly saying, we saw some inflation prints that came in hotter. I think it's now consensus, which you guys have been saying on the pod, that, although the second derivative is slowing, that it's sticky, right? We're going to get stuck at this 4, 4.5, 3.5. And it's the slope of the curve downward is going to be slower. We've gone from thinking we're going to have 225s to now thinking we'll have 3 or 4. And so I think everybody is now bracing for more inflation. But remember, when we started the year on January 1st, the consensus wisdom was we were going to retest the S&P at 3,200. We were going to have an earnings recession, and that inflation was going to continue to run hotter. The only surprise in my mind so far this year is how well the equity markets have held up in the face of a 10-year that's gone parabolic.
Chamath highlights that taxpayers are ultimately responsible for this increased spending. He believes that the interest rates will definitely be higher and will persist for a longer period. Chamath says that going against the consensus view could be profitable, as the market is still uncertain about whether this is just a temporary bump in the road or the beginning of an earnings recession. He also points out the cash flow versus earnings for companies, indicating that there is currently a significant gap between what companies are reporting as earnings and what's actually in their bank accounts. This suggests that in the broader economic landscape, things may not be what they seem. What do you think about Chamath's economic outlook for this year, and how the Fed's rise in interest rates will affect the stock, crypto, and housing markets in 2023? Comment down below. Thanks so much for watching. Don't forget to like and subscribe. This is Library of Wealth. We'll see you in the next video.